everyone. Welcome to today's presentation. Today we're going to be talking about building a feast or famine budget. How can you have a steady life and steady income stream to your personal accounts, even when your income is variable and all over the place? I thought this would be a good webinar for today because I know that summer begins a little bit slower period for a lot of court reporters, and maybe you're taking some time off, and that will also affect you. So looking at what to do when we do have those slow months and how to plan around that. And also when we have those good months can help give you a little bit more comfort and peace of mind with the changes in your income and your cash flows, where you can just have a steady, consistent, both budget and also financial plan. Some of the problems that I've seen is that you have good months where you may make $15,000 or $25,000, and the next month you're down to making $5,000. Took some time off, jobs were slow, and it can feel very cyclical on the personal side of your own income and spending. And when we have the good months, you feel like everything's going really well, and maybe you spend a bit more, increase your lifestyle a little bit, and think that it's going to continue. Next thing, we have some slow months and we start to stress out, maybe go into a little bit of credit card debt, trying to figure out how we're going to get through this period. And it just creates this kind of unnecessary stress and anxiety around your finances. So the problem is that many people want to have a budget as a court reporter, but you have such fluctuating income that things are a little bit different than your traditional W-2 salaried employee that's getting the same paycheck coming in every 2 weeks. The core shift that we need to make is thinking about the budget as the floor, not the ceiling of what your income is. So what this means is that we want to stop planning around when things happen really well and are going good in your financial plan, but looking at what are kind of like the worst case scenarios of the slow months that you're going to have, and planning around that as your baseline. And then we can start to build and add more on top of that. So the first thing that we need to do is figure out what that baseline is as far as what is a bad month. So in order to do that, look back at either the last year or the last 2 years and see what were the slow months that you had and how much money did you make during those months. Now, I wouldn't think of this as if you had an injury or something that put you out of work or like a very weird one-off situation, but more looking at when you're trying to follow a consistent monthly budget, what were you spending and what did that look like? So figure out what the cash flows looked like for those months, how much were you spending and how much were you making, finding those lowest months. And then you want to try and line that up with your fixed expenses. So you want to make sure, and this is actually how we think about a retirement plan as well, but you want to make sure that you always have your fixed expenses covered. But because I think that's the first part about helping with the kind of stress and anxiety is that you don't even know if you're going to be able to pay the mortgage or pay those standard bills that you know are coming up. So if you can match up your fixed expenses with kind of your baseline income, then that really means that everything above and beyond that is where the discretionary spending comes in. That's where the fun stuff happens, but you know that you're going to be okay and that you'll make it through. So that's step one. Step two is now going to be adding on to that budget through a buffer account. And basically what a buffer account is like, it's like an emergency fund, but the emergency fund, I more think of, hey, we're going to set this account up and leave it and never touch it for as long as we can until there's some major life expense that comes up and you need the money. The buffer account is an account that you would actually pull from a lot more often. And this is almost like the account that smooths out the ride of your income to stabilize it where you want to be. So when you do have those good months, you can add that money to the buffer account. And then when you have the slow months, that's where you can pull to kind of make up the gaps that you need. So I would target around 2 to 3 months of salary. And what I mean by salary is what you're planning to pay yourself consistently every month between both your fixed expenses and your discretionary. What's your total amount that you need every month to live? I would have 2 to 3 months of that sitting in either a buffer account or a business savings account would work as well for this. But really any account where you just have this money set aside for this flexible spending, that's going to be the place to put it. And then basically you're just going to use it as things come up to just level off the overall experience that you're having with those fluctuating income levels. So once you do have kind of the buffer filled up, then we get to the next step of your financial plan, right? Just think of this as building blocks. So building block number one is that your fixed expenses were covered no matter what from the minimum amount of money that you're making. So we always have the fixed expenses covered. Then number two is the buffer account. Now you have a buffer account with 2 to 3 months of spending need that's going to help level off any of those changes in income that may happen throughout the year. Step number three, the next building block on top of that is, okay, what if I fill up the buffer account and I have even more money on top of that during those good months? I don't need to just keep putting money in savings. So now what's the next piece of the plan that I could focus on? So of course, number one is refilling that buffer, like I just mentioned. But number two is maybe we need to set aside some extra money for taxes, right? Because if you're doing good enough to be having this extra income, maybe it's a really good year for you, or you just want to make sure that you're going to be well protected for any expenses. So you set aside some extra tax money. The next place to go to would be like your personal emergency fund. So everything looks good on the business. You can keep paying yourself a consistent amount every month. But then now on the personal side, you still need an emergency fund for unexpected expenses that may come up. Your air conditioning goes out, you need a roof repair, you need to have that extra money ready to go for any of those one-off emergencies. And the goal there is that you can pay for that emergency and you still have the business accounts that keep paying you that monthly amount every single month. So it's like that guaranteed income still coming in from the business and you can afford to pay for that one-off expense. Now, the next piece is the fun part where we get to start adding some retirement and investments. So now that we have your emergency fund covered, your taxes are covered, your buffers built up, now we get to add this retirement and investment piece to start investing and growing money for your future. So that can be multiple different accounts, and we've had other webinars on that in the past. So you can go back and watch some of those on what's going to be the right account to set up. But that would be the next piece to add to your plan. And then lastly is the fund money, right? So if you're saving enough for retirement and for the goals that you have, and you have money left over, now maybe we need to circle all the way back to the beginning and give yourself a raise and start increasing how much you get to send to yourself just to be able to go spend. Or you can even just do like a one-off bonus if it was an especially good pay period and the last month or two was especially good for you. Maybe you just get to send yourself a few grand extra and you can choose to either put that toward a vacation, sit it in the emergency fund until you're ready to spend it on something, or if you really have no use for it, there can always be more money put toward retirement, and you can just keep building those investment accounts and growing that. So some of the mistakes that you want to avoid with the kind of feast or famine lifestyle that you have as a court reporter is the new normal trap, right? So that's what I mentioned. When you have really good months, you want to make sure that you don't slowly increase your lifestyle and treat the big month as a permanent thing, that you're going to have that every month going forward. Also, I've seen that people get a really good month of income and then they don't think about how that means there's a lot more extra money that needs to go toward taxes. So they still set aside the same dollar number that they always set aside for taxes, and they're not accounting for this extra amount of income that they've made. That's probably increasing their tax bill, and they need to set more money aside for that. So that's the second one I have on here, is skipping the tax set aside when cash flow feels abundant. Make sure that you're keeping tabs on how you did compared to last year. How much taxes did you owe last year? And do you need to set more aside because you're having a historically good year? The next is no buffer. So if you're able to make through and get by when things are going well and when you have a lot of money, but then when you have those slow months, you don't have that surplus built up, and now you need to put things on credit cards to get through those slow months. That's just extra interest that we don't need to pay on some of your spending. And honestly, as a court reporter, you should have at least a year's worth of expenses sitting in cash at all times, because the odds of being out of work are just especially high for your career, because it doesn't really take a whole lot to not be able to do your job. So you need to make sure that you have that buffer And the last thing you want to do is have to use credit cards to get you through during those slow months. And then the last one, I've mentioned this a little bit here and there already, is the lifestyle creep, where you have good months, and then those good months, you raise your spending, even if it's just a little bit. Then those bad months, you're like, hey, I didn't change my lifestyle, but maybe you added a couple subscriptions here and there. You started getting coffee a little bit more, going out to eat a little bit more. And then that just keeps happening whenever you have a good month. And next thing you know, you're back to this no buffer here where you can't afford your lifestyle during the bad months because you just slowly increased it over the last good months that you had. So this is a sample of a freelancer's numbers to think about. So this is just fluctuating income that could be coming in anywhere from 5,000 as the slow months all the way up to 15,000 as the good months. And what you can do is what the court reporter I have here is that she's paying herself a steady $6,500 a month salary. Part of this is coming from payroll. Part of this is coming from owner distributions if she's an S corp. If she's just a sole proprietor, then it would just be sending 6,500 a month from business accounts to personal accounts. And then there's enough buffer here that can absorb the swings of the good months and the bad months. So when there is a month like January where $5,000 is only the income, but the spending was 6,500, we have that buffer to get by during that month. And then you can see February rebounded back where we were back above what the spending amount was. So this is going to help a lot with making sure that it's just a consistent $6,500 that she gets every month. It's not fluctuating income and feeling the ebbs and flows of your business. Taxes, you can have that set aside, and auto transfer is great, or even doing 25% of whatever you make every month can be a great game plan to start with until you can start to have some real numbers to work off of. And hopefully this will just give you a more predictable life. You can basically treat yourself as an employee and a W-2 person where you just get the same amount every month. You spend that, you live off that, and then you can make adjustments as needed from there. So lastly, some action steps if you're looking to make a change when it comes to your cash flows and how you're managing your income is calculate that baseline like I mentioned. What's the worst case scenario that you've experienced over the last 12 to 24 months? Open up a buffer account if you don't have either a business savings or even just an extra checking account to sock money away. Open that up and have that buffer built up when you need it. Figure out what that set fixed salary is going to be. So what's the number that's at or below your baseline floor when it comes to your fixed expenses, where even in those bad months, I know that I could pay for all these bills, no problem. And then you can look at going a little bit higher than that when you add on some discretionary spending, knowing that buffer will help get you by during those especially slow periods. And then lastly is automate taxes and savings as well. So you have automated cash flow going from business to personal, and then also having automated savings for taxes and automated savings into your financial plan. Everything's just going to be nice and even and consistent throughout the year. The only thing that's going to be fluctuating is your business accounts and your buffer accounts, but none of that really ever needs to be felt on your personal side because you'll always have enough backup money there to get through. If you want to talk about this more on your specific financial situation, if you're thinking about adding to your retirement plan, or you want to know how making contributions towards your retirement can help you save on taxes and just having a nice, more organized and anxiety-free financial plan, feel free to reach out to me. You can send me an email at brandon@traction-wealth.com, and we can talk a little bit more about your individual situation. Feel free to leave any questions in the comments. Otherwise, I'll see you all next week.